Good morning. It is June 7th, 2019, and we are going to talk oil again because it's what we like to do, and hopefully everybody can understand what I'm trying to say and what I'm trying to see. Let's start with some headlines from this week. U.S. and Russian warships nearly collide in the Pacific. If you haven't watched this video, I encourage you to do it. The Russians were being frisky this week. Had an encounter over the Mediterranean Sea and two encounters off the Alaskan coast. Don't have a lot to say about this other than can't possibly see anything going wrong with these sorts of things happening more often. You don't know if it can have an impact on policy in the Middle East, because that seems to be the place where we get into the most trouble with the Russians, with Syria and maybe Iran. We shall see. Hopefully this is just playing around and flexing muscles and strutting peacock feathers, but you never know. So we're going to talk about the new paradigm crushing oil and gas stocks, and oil for that matter. Wrote kind of a summary piece for Margin of Safety and Fundamental Trends this week in FA Trader. And I'll have a couple of offshoot pieces based on different topics in here. But we went through what really has happened in oil and gas over the last, say, 4 or 5 years. And I think it's important to walk through the history to really understand. In the last 9 months, my investments in oil and gas have gotten just beat the heck since September. So we got the big rally, and we probably should have closed all of our positions in September of last year rather than just trimming. I wish I had done that. It was a mistake not to. However, I don't know that a lot of people really anticipated the fourth quarter that we ended up having last year. A lot of folks thought we'd have a huge rally at the end of last year. I talked about October being a rough month. I didn't even see it becoming as bad as it did, though. So we never got that rally in December until December 26th is when it started. So the correction lasted all the way from October to December 24th. And then we got the V-shaped recovery. But of course, a lot of damage had been done in those other 7 weeks that I think was a lot worse than what really anybody expected. Now that we know that that can happen, we have to be careful, obviously. The oil stocks have been getting beat up for really a handful of reasons. The first is that obviously shale has produced a lot of oil, and our oil producers don't have the common sense that I thought they would have after the last collapse. They are not putting their foot down on production. And only capital constraints are going to do that, in my opinion. I think that we are going to have to see the banks and Wall Street continue to crack down on lending money to unprofitable oil companies. And I think that we are going to have to see a lot of mergers in the shale space. Now, that will make the companies that merge very profitable. Because then they can cut back on their spending and basically have flat production curves. And flat production curves are better than growing production curves, because the growing production curves contribute to the price of oil staying very low and ultimately these companies not having a good experience. The problem is that many of the executives at these companies get paid based on different metrics, and there is a huge skim in my opinion, going on in the oil companies. Basically, the executives are stealing money as far as I can tell. And at some point, shareholders are going to have to make a decision on whether or not they want to stand up for their rights. So I'm going to write a little article. This is the working title. Maybe I change it, maybe I don't. But I'm going to flat out accuse the executives of being shitty at their jobs or being thieves. Take your pick. They can respond how they want to respond. Last time I wrote something like this, challenging back in 2016 maybe, I said that we were at the beginning of the end of the oil age, and I got hate mail and even people calling me, pretending to be potential clients and then telling me I was crazy. Well, clearly, we have seen that we are at the beginning of the end of the oil age. Now, that doesn't mean that it ends tomorrow. It means that it's a process that has begun. And we are seeing a huge fossil fuel stock divestment movement on top of that. There are over 1,000 institutions who have pledged to sell their fossil fuel investments. And their rationale isn't entirely environmental, because obviously if you are a financial institution, you are a fiduciary, and you have to justify selling those investments as good for your client. So they are making the argument that it is good to sell fossil fuel investments because they're bad investments. And so far they've been right. Oil stocks have not done well over the last 3 years. Here's your chart. You know, these are some of the main funds that we've used. And XOP is here at the bottom, down 28% over 3 years. XLE is basically even. This is a price, this is total return price, includes dividends. Then you have your S&P 500, QQQ, and then some of our favorite funds are the ARK funds. And I would just point out that what is their top holding? Their top holding is Tesla. And they've crushed the market over the last 3 years. Interestingly, we talked about Tesla just recently, just a couple of weeks ago. Dave Zanoni and I both talked about it. I did it in a webinar. He did it in a piece. We caught the bottom in Tesla, at least the recent bottom. Doesn't mean it's the last bottom. But we caught the recent bottom pretty close. You know, this is a price range in that around 180 that I suggested, hey, if you don't own any, nibble in. I didn't add to my position there just because it wasn't a big enough difference based on the potential drop to add more. But I do own some ARK funds and I do own some Tesla, and it has rebounded over $200 a share again because what I said, which was that they would not miss their production numbers again, looks like it's going to be right. And the analysts are coming out and saying, oh, yep, looks like they're going to meet their production and delivery numbers after that rough first quarter. And I think that long-term, the trends are in that favor. And remember, sometime next year, China comes online for Tesla. That plant will be up and running right around New Year's, a little before, a little after, we'll see. Regardless, I think that paying attention to companies like Tesla and other companies that are involved with alternative energy, smart grid, things like that, really screams at us that this paradigm shift away from oil is real. And again, it'll take years, decades, but there's going to be constant pressure on oil stocks from divestment movement. Norway sold off $7.5 billion worth of oil stocks. Maybe they're still in the process of doing it. Hard to know. Then, you know, here's your list of companies that Norway owned that they're divesting all of these. a big list, right? Now, in the context of what that is to the whole market, though, not real big. $7.5 billion is, not very much in the scheme of the market cap, rough market cap now of the energy sector in the S&P 500, which is 1.7 trillion. So, right, it's a teeny tiny percentage. But of the money that is on the float, right, that trades, it was a big number. So in a thinly traded market, which, and we are thinly traded, we have the this article, 4 pieces of missing money crushing the markets. There's still 2 pieces right now that are missing. 2 of the pieces came back. We're not having tax loss selling right now, but maybe we see that in oil stocks at the end of the year. We'll see. In a thinly traded market, the traders become more powerful. So if there's no underlying marginal buyer, foreigners or the Federal Reserve pumping money to the primary banks or a big wave of retail, then traders get more powerful because they control more of the active float, and that pushes prices around. So when prices drop 10% or 20%, people get all up in arms. Oh my God, what's happening? All that's happening is the traders are pushing in one direction or the other. Momentum is a powerful force, and it's a more powerful force when there isn't an underlying buyer. And we've talked about that last year in July, August, and September, that the marginal buyers, right, that the buy the dip crowd has thinned up. You don't have your foreign segment. China's not investing in the United States at the moment. I expect a flood of Chinese capital at some point, but I think it will be post trade skirmish that appears to be turning into a trade war. We'll see. In any case, the fossil fuel thing, let's just focus on oil. We know that coal is dying, right? The EIA curve shows that coal is dying, and probably by 2030, there isn't but a handful of coal-fired power plants in the United States. Already we saw in Indiana, they're going to close a coal-fired power plant and replace it with wind, solar, and batteries. And that's in Indiana. Indiana is the #1 state for percentage of energy generated by coal. Very entrenched there. And the special interests are fighting it, but they're going to lose because the bottom line is that the utility is going to save, it was something like $1.5 billion in the first 5 years and $6 billion over 15 or 20 years by switching to alternative energy. That's not starting from scratch. What kind of power plant do we build? They're actually going to tear down a coal power plant and replace it. So it's cheaper to build a new alternative energy power plant in Indiana than it is to continue operating coal. So anybody still holding on to the coal notion or voting based on coal to save those jobs, really, we just need to find those people different jobs because they're going away no matter what. Oil is going to go away to a large extent by the middle of the century. Probably will cut our oil demand in half, give or take, by 2050. The idea that oil demand is going to keep rising to 2040 is insane. It's not going to happen. You have China and India already passing laws that virtually nobody other than the super rich and connected will be able to buy a gasoline-powered car after 2030. So how long do cars last? There's just going to be a huge drop in oil demand in the 2030s. It will drift up for another 3, 4, 5 years, 6 years maybe, give or take. And then we'll have that peak oil plateau that I talked about where demand is flat and supply is roughly, the same. So there will be a balanced market. But eventually, the countries that need cheap energy and have oil off their coast are going to pump it. and that's going to crash the price of oil. So by sometime in the late 2020s, early 2030s, you're going to see the price of oil crash, and it's going to stay down, as far as we're concerned, forever, right? Forever for us is as long as we live, and that's long enough. Does the price of oil get more expensive 30, 40 years out? Yeah, maybe. You know, maybe there's enough demand and, you know, not a lot of capital investment. The Saudis will provide most of that oil, and then what's left of our shale will provide some, you know, some Gulf of Mexico. But, you know, at some point, oil becomes more expensive because it will just be harder to get. And we already can see that the technology that has made drilling oil cheaper is being offset by the fact that we're moving on to the harder to get oil. So the high grading of oil, which means that we drill the easiest stuff and cheapest stuff first, is ending. It is very difficult to find cheap oil anymore. And that is why the deal for Occidental to buy Anadarko, in my opinion, is a great deal. Now, did they pay a little bit more than Chevron? Sure. But Chevron was bottom fishing. They were trying to get Anadarko for cheap. And the Anadarko executives scammed. They outright scammed. They should go to jail as far as I'm concerned. Scammed the system by cutting that deal with Chevron, but the day before voting themselves big raises if there was a change in control. Chevron participated because they were like, well, you know, if you break up this deal, because they all knew the Occidentals after them, they were talking for 2 years. Chevron gets in there with a lowball offer and a $1 billion breakup fee. So that $1 billion breakup fee came right out of shareholders, and the executives got hundreds of millions of it. If you're a shareholder in oil stocks, you should be pissed off, because executives like the ones at Anadarko and other companies are robbing you blind. They should be flattening out their production curves. They should be merging, and they should stop voting themselves hundreds and thousands of percent raises and stealing your money. They are stealing your money, and you're not doing a damn thing about it. You should be contacting senators and congressmen and writing to the executives and the board of directors and the big pension funds that control shares, because it should be an outrage, and Americans just sit back and they take it because, oh, white collar crime isn't that big of a deal. It's just taking my hard-earned money. It's not like they killed me or something. Bullshit. These guys are criminals, and the Anadarko executives should have to give back all of that money. All of it. They didn't do anything for shareholders. They didn't even get a higher price compared to 3 years ago. Anyway, so at some point, Saudi Arabia will get control of the price of oil because they are the marginal producer and always will be, because they have the cheapest oil. The cheapest oil is always the marginal producer, or the cheapest anybody in any industry is always the marginal producer if they have the capacity. Saudi Arabia is going to get control of the price of oil here in the next 1 or 2 years. I have put the likelihood that the Democrats get the presidency at between 87 and 94% next year. Why? Because they won the midterms by 8.8 million votes. That's nuts. That's huge. The odds of President Trump overcoming that next year, even if the economy is booming, is pretty small. So if the Democrats get the presidency, that's very good for the oil stocks short term. Why? Because the Democrats will throw up roadblocks to more production. So the Democrats will do what the executives refuse to do, which is they'll push down production. They'll flatten it out. That'll raise the price of oil. You'll get your rally, and hopefully we can all exit these positions whole. Right now, I need to make around a 30% gain just to be even. So, that probably happens. Although I want people to keep in mind who are inclined to average down. You need to understand your asset allocation. You don't want to have, I'd say any more than a quarter of your money invested in any sector other than tech. Tech, you can have more, you can have up to half of your money in tech. I know people who have all their money in tech, but I think that they are willing to ride these waves. So if you have money in oil stocks already, remember this old adage: you don't have to make your money back where you lost it. You can invest somewhere else. And if you make your money in spot B, even though you lost it in spot A, you still made your money back. So while I'm going to ride out my oil positions because I like the ones that I have, I own companies that are probably going to be involved in mergers and acquisitions. Devon Energy, if you don't own Devon, that's probably one of the ones I'd look at among the diversified shale plays. We know that they are in active discussions to merge. We know that. Who it is, not so sure. I think it's Marathon Oil. I'm not positive. The pure play Permian companies, I'm going to write a piece, and I'm going to try to cause trouble here over the next month or two. But I think that several of the Permian companies, not just one or not just two, I think a few of the Permian companies ought to merge, create a large Permian pure play, maybe call it Permian Resources, if that name's not taken, or Permian Oil and Gas. I call it Permian Resources because eventually they'll have water rights, and they could do wind, they could do solar and wind farms too, which just happened this week. I forget who it was, but somebody cut a deal with Sun Power or somebody, Canadian Solar maybe. But one of the big oil companies is going to power their oil fields with solar. What does that tell you? It's a paradigm shift, right? The long-term trend for fossil fuel investing is down, and that's never going to change. So we have to navigate this and use the next bull market to exit. That doesn't mean I'd be adding more now, though. I'd just be letting your positions come back to you. And honestly, if you find something that you think is just dramatically better than an oil stock, it doesn't hurt you to switch. However, oil stocks are beat up so bad that some of these best companies that are down 50%, they'll probably double back near their short-term high, their 2 to 5 year highs. They may not make it back to all-time highs. I would anticipate that they won't. But their 2 to 5 year highs, if you take a look at a company like Devon, you put it on a 10-year chart, you take a look, up here, $90 a share. I don't think it sees $90 a share again. But here, this 5 year high for $50 a share, I think you can make a run at $50 a share, especially if it does a merger with a Marathon Oil or something. Take a look at Marathon Oil. A lot of these companies are run pretty well. They're down at, what are they, $13 a share right now. I mean, if you don't think they're going to zero, you buy this right here. And then you let it double up, towards into the 20s and 30s for you. Maybe you get lucky and you get a triple. The reason I don't buy more calls at the moment is because the time value that we were paying was pretty expensive. We missed 2 freaking exit opportunities. And now we have to get a third exit opportunity and trade it better. But if you don't think that these companies are going to zero, you ought to buy them. And look at the trend here, the bottom. Hugely volatile, but higher lows, right? So it should bounce off of this December level you know, 1250. I don't think it got down to 1250 recently. No, it did not get down there. So higher lows. That's good. So I would be buying the companies if you're a trader and you want to trade these. I think they're good trades. If you don't have much position in oil, this is a great bottom feeding spot. But again, if you have a large asset allocation to oil already, you may want to look elsewhere to expand your holdings. And I already closed that chart, but notice, I'll just throw this out here. The Vanguard Dividend Appreciation Fund has not outperformed the S&P 500. So all these folks who talk about dividends, you have to discern between dividend stocks. Dividend stocks without growth characteristics suck. They don't outperform the market. They just don't. So keep that in mind. But we take that out of here. We throw in the ARK funds, the ARK Innovation Fund. I mean, my two holdings, core holdings at this point, are the ARK Innovation Fund and QQQ. Don't own much of them right now because back in April we told you raise cash, right? Back in April we told you raise cash. I don't know. There you go. Back in April, fade the April rally, move to safer 401k allocation. And we talked about that in our asset allocations. Should you be jumping into the stock market rally? Again, it depends on how you feel about your asset allocation, right? How do you feel about risk? Do you think this is just a relief rally? Or do you think it's the start of a major rally? I do think a pretty big rally is coming just because the Federal Reserve is going to end quantitative tightening in September. I could see a really good fourth quarter. I thought that last year too. So keep that in mind. We need to, forecast less and react more. That is the world that we're in now. And while we can argue any narrative that we want to, the reality is that investor sentiment is important. But what is probably more important is capital flows from other sources. And right now, $50 billion a month is coming out of the system because of the quantitative tightening. When that $50 billion is no longer coming out of the system, that'll probably be very stimulative, at least while the buybacks remain on top of that. So in the fourth quarter, we should have the opposite impact than that we had last year in the fourth quarter. It should be the opposite. This year, you won't get tax loss selling because it's not a down year. You'll have quantitative tightening ending, not starting. It started last October, it got up to 50 billion. And we have even bigger buybacks this year, right? So, and the economy hasn't yet slowed down from the trade skirmish. Will the trade skirmish turn into a full-blown trade war? I think for a little while it might. The positive surprises haven't happened. We're getting pretty talk on trade this week. We'll see if it matters. We'll see if there really is any meeting of the minds in a couple of weeks at the G20 summit. I don't know. I think the Chinese have made it very clear that Donald Trump will not bully them. And now it's going to be up to the administration. Will they give the Chinese a deal that they're willing to live with? And my experience with the Chinese, and going all the way back to 1991, when a Chinese dissident professor told me that this is the way things operate, and it's been proven right ever since, the Chinese aren't looking for a fair deal right now. At this point, they want to see if they can pressure Donald Trump into cutting a deal that he doesn't want to cut so that he can get reelected. Here's the thing. I'm not so sure that Donald Trump really cares if he gets reelected. I really don't. I don't know that he cares. I think he wants to make sure that he is true to his base, because those are the folks that are going to buy into his media company that he started a couple months before the election. You know, he's playing the long game. Does he enjoy being president? Nah, he doesn't enjoy being president. He doesn't like losing either. But at the same time, if the consolation prize is that he makes a ton of money doing a new media network on TV and the internet, one of his best buddies is the guy from Newsmax, and obviously the guy from Breitbart, Steve Bannon, worked with him. So I just see Donald Trump getting into that business. And I'm not so sure that he would allow the Chinese to push him around, because that would damage that business. So I think that we are more likely to get the trade war today than we were a year ago, when I didn't think it would happen. I thought there'd just be dancing, and then everybody would go back to their side of the room and look at each other from their wall. But I think that we're very likely to get this trade war now. And by January, February, March, probably for sure by April, May, June, by Q2, we're going to be feeling it. It would not surprise me if we had a negative GDP quarter in Q1, maybe even an official recession in Q1 and Q2 of next year. We'll see. The canary in the coal mine is whether or not unemployment ticks up. If unemployment goes up, then that is the harbinger for a massive market sell-off. Why? Around half of the people who get fired cash in their 401ks. We know this. Could be a little more, could be a little less. So if the unemployment rate goes up, you need to start selling quickly. Because as soon as those 401ks get distributed 30 and 90 days later, that's it. There's a flood of money coming out of the markets. And it'll be even across the board, because in people's 401ks, it's mainly, mutual funds. So keep an eye on the unemployment rate. If it starts ticking up by more than 1/10 or 2/10, it starts going to 4.2, 4.4, 4.8, head for the hills. In the meantime, oil demand actually isn't that impacted when unemployment and GDP slows down, only by maybe 1 million barrels to 2 million barrels a day, and that can be taken out of supply. I would be shocked if there's not a major drawdown of oil and distillates in the next 4 to 5 months, because at the end of the year, ISO 2020, which is the shipping regulations on fuel, kick in. And the refineries are already switching over to provide different ship fuels, to get down to the 0.5% of sulfur from 3.5%. I mean, it's a huge cut. So that'll be good for light sweet crude, right? Because that's what you turn into gasoline and other fuels. And I think the refiners probably make a pretty good rally at some point. And you might have a disconnected market where gold does relatively well. We bought Newmont Mining recently. And oil rallies in the face of everything else going down. So we will keep in mind. Because at this point, all the people who can sell oil oil stocks have pretty much done it. There's just not much more bottom to get to. This is it's been a wipeout. So again, I'm not saying buy more oil stocks. Just understand the dynamics, and if you have oil holdings, consider why things have happened, and what the likely outcomes are, and that over the next year to 2 years, you might want to be an oil trader and not just a buy and holder. Although, like I said, if the Democrats win the White House, And if they somehow take the Senate, which is at this point just a coin flip, then the price of oil is going to go up, because a higher price of oil drives adoption of alternative energy. And that's what they want. And I agree with them, to be honest with you. I've thought that this would happen. So Tony Seba, I kind of argued with a little bit. I basically said he was right, but that he was forecasting a lot of this stuff was going to happen with the price of oil and adoption of EVs way too fast. You know, he's saying price of barrel of oil dramatically fall by 2030. I have come into alignment with that. I think that 2030 is the year that oil, give or take, you know, a year or two, you know, maybe a year earlier, maybe a year later, something like that. But right around 2030 is when oil demand starts to fall. And that's when we'll get the next perpetual crash in oil prices. And we'll see what happens after that. But for us as investors, we pretty much care about the next 3 to 5 years. The very long term, the 10 to 15-year outlook, we need to be looking at these revolutionary companies. And, you know, a good place to just look is, you know, look at the ARC Innovation Fund. Just look at their holdings. You know, these are the names that are making our sustainable growth list. Not all of them. Like, I don't like Netflix. Why don't I like Netflix? Because I think AT&T and Disney are going to challenge them. AT&T with HBO and their new streaming services. And I think Disney and Hulu, which Disney has control of now, are going to be a big deal. And YouTube TV is very good. I have YouTube TV so I can see local sports. So Netflix's growth, I think, is going to slow dramatically because they're going to have so many challengers, right? They were the first mover, but at this point, it's going to be based on salespeople. AT&T's got them. And brand name, Disney's got it. And marketing might. Google has that, right? Netflix is not undisputed anymore. They do not have a growth path that Amazon had for 15, 20 years. Netflix's hyper growth is over. And, you know, so we have to discern where we want to be. You know, Tencent, China, a lot of these China stocks are getting crushed. I don't know that I want to own any China stock other than Alibaba because of their cloud business. But I can get some Tencent exposure through, you know, through the ARC funds, right? And it's on a dip here, and it probably is a good spot to buy if you have the stomach for it. I don't think that I do. I'll be 50 next year. I'm starting to wear out on excitement. But yeah, a lot of these, Splunk, interesting company. You know, Baidu, here you go. You're getting your Chinese exposure in here. The woman that runs this fund is very good. So this is a core holding for me at this point. You know, 10, 12% of the portfolio. In any case, let's take a couple of questions. Why are super major stocks stable? Because idiots aren't selling it yet. There. People who own Chevron and Exxon don't understand what they're invested in. Chevron and Exxon will eventually crash. And they will crash hard because who is going to buy their assets? Who? Who can they sell their assets to? They're going to have trillions of revenue that never happens, either through sale of products or sale of land. So there will be a breakup of Chevron and Exxon at some point. Exxon probably first, I think, because I think they'll be forced to. Maybe Chevron because they're smarter, hard to know. Chevron's clearly got better management than Exxon. But we'll see. I think they split those companies up. The downstream gets split off, and all those real estate holdings maybe get thrown into a REIT. The midstream pipelines, I think that you could see a major consolidation in the pipeline industry down to 5 players over the next 10 to 15 years. And that could be good for companies like Kinder Morgan, which we're in, right? Kinder Morgan's up $6, so 40%. Since we started buying Kinder Morgan a couple of years ago, Kinder Morgan's up about 40%. So, Occidental, I think the bottom is in. Looks that way over the last week. We'll find out. Every time we say that, it goes down more. But the technical indicators really make it look like, because it was hugely oversold, right? RSI was super hugely oversold. You know, money flow was very oversold, not maximum oversold, but very oversold. I mean, look at that. If you don't think it's going to zero, you probably are a buyer. You know, I mean, this is screaming at you. I don't have my other system up, but balance of power and time segmented volume and things like that, they're basically saying that this looks like the bottom for all these oil stocks. 50% of oil stocks hit their 52-week low in the last 10 days. And that's massive. So, all right. Do I prefer the ARK Web Fund or the ARK Innovation Fund? I am currently in the ARK Web Fund because I have not found biotech to be particularly attractive lately. If biotech gets a big correction, then I'd go into the ARK Innovation Fund because that fund holds biotech. And between the biotech and QQQ and the biotech, which is more mid-cap, small-cap, mid-cap, over at ARK, you get a good spread of biotech then. But right now, I'm not terribly interested in biotech until they get a bigger smackdown, at which point I'd probably add the ARK Innovation Fund. Payment system stocks, will they eventually be bought by Visa or MasterCard? Square, PayPal, things like that. I don't know. I think PayPal is an attractive takeover target, so is Square. I think Google is always a candidate to buy everything, although they're very restrained. I still think baby Googles are coming, and I think that will be the impetus for Google to make bigger forays into mergers and acquisitions. Will MasterCard or Visa get into those, get into the Square PayPal business? I don't know. I don't really know if that's a natural progression for them, right? Because they go from asset light to asset heavy at that point. So I don't know. What about Facebook coin? I think that Facebook, if you go back to my article, way back at Facebook's IPO, I don't remember the name of the article, but a few months after Facebook's IPO, anyway, on Market Watch, I told everybody to buy Facebook when it got into the 20s. And my rationale was that they were going to have huge revenue from advertising. and that they could even do a subscription fee. They ended up not doing the subscription fee, but they have gotten a lot of money from advertising, and they brokered your data. So they sold your data without you really knowing about it to all these other sources. Well, regulation is coming down against them, and they're not going to be able to sell data, which is why we invested in that microcap a little while ago, and maybe we'll buy some more if it starts to rise. But Facebook's going to have a revenue problem. Not that they're going to lose money, but their revenues are going to stop going up. And their Facebook coin is a way to try to capture a marketplace, right? That basically their version of Craigslist, and create something, that's tradable, where you'll keep money on the Facebook platform, that they'll get money from the float, which is actually, I think, there's rules on that now, that they won't make as much as, say insurance companies used to. So I don't know that Facebook coin is that important. There's a lot of companies out there that are doing virtual coins, doing Bitcoin types of stuff. Starbucks, I think, is a better play on that, right? Because then you're taking part in every single transaction that has to do with coffee for anybody who uses Starbucks bucks or whatever they're going to call it. So I don't know the Facebook coin's that important. I could be wrong. Maybe everybody starts, maybe Facebook replaces eBay. We'll see. I thought the Facebook should have bought eBay a couple of years ago. They didn't. They did their own thing because Zuckerberg doesn't want to spend the money on somebody else's tech. But you would have gotten all those marketplaces, could have built them right into Facebook. I think they made a mistake not buying eBay. Now, could they still buy eBay? I don't know. What is eBay trading at nowadays? $32 billion market cap. Yeah, they ain't buying eBay. Unless eBay crashes down here, but at that point, that means they're losing customers. So I don't know. I think that Facebook is damned if they do, damned if they don't here. If I'm Facebook, I do two things. I acquire eBay with shares and dilute the Facebook stock one time, and then I start paying a dividend. That's what I do. So Facebook doesn't sell data. That's bullshit. They absolutely do. Yeah, no, I mean, yeah, Facebook will, Facebook, like I said, they'll have revenue. Their growth is over. They're big. There's not much for them to grow anymore. Now they have to muddle through like a large cap. They're not a growth company anymore. Neither is Netflix. So, I think the danger is worse for Netflix. What I said 5 years ago or whatever it was when Facebook IPO'd is that eventually Facebook would be the digital version of that little telephone book that you used to have by your corded phone. Right? You remember that little book? Everybody's number, and then you'd write little notes in there. Oh yeah, their kid's name is whatever it is. This is the digital version. You have events. You can see what they ate for dinner last night. Important life things. I only post on Facebook once or twice a week now. My last post was that I'm going to have a bonfire on Saturday night, and it's practice for the final fire. And I had the final fire a couple of years ago because I was going to move, and then I didn't. So this year is the final fire because I am moving on September 30th, in with a girlfriend. I figured I should try it one more time before I'm, old. So is the 10-year Treasury going to break the September 2017 low? Next year, I think it will. I do. I think it'll break the 2017 low or match it. It'll double bottom, something along that line. Schlumberger approaching 6% yield. I don't like any of the service stocks anymore. Helmerich and Payne, I like a little bit, but not enough to make my list. We have new focused lists. So we've been working on this. You know, we've got our asset allocation models. This is where we're at right now. Global Trends ETF. Somebody asked if I'm going to make a change in June. We'll see. I don't do it monthly. I do it based on the market, right? It's not based on the calendar. It's based on the market. This is where we're at right now. Invesco QQQ, ARK Innovation, Invesco Russell Pure Growth, which is mid cap. Got XOP. I really wish I didn't. The Invesco Small Cap Low Vol, Clean Energy, Australia, Malaysia, cash. Right? Just starting to get into Malaysia. I think Malaysia has huge upside. Don't know when it happens. Okay. ETF favorites, all the stocks in there. I have a chart in here that kind of shows, you know, how different stocks of ETFs have done over the last several years. And the point of this really is to show that the dividend ETFs do not outperform, not by much, and they're not any less volatile. There's a lot of hype around dividend, and the problem is that a third of the dividend stocks suck. Too high a debt, too low a growth. I mean, a lot of them are going to drop 50% on you. Vietnam is on my radar. Right? So Dow Jones Industrial Stock, have our support levels, bottom fishing. The Sustainable Growth 30 I'm still working on. Soon enough, it'll look like the dividend growth stocks. I'm just, all these portfolios be around 30 stocks, or not portfolios, but our focus lists be around 30 stocks. I think this one's 33, right? I know people take screenshots. I don't care. I'd rather have people make a little bit of money and not pay me than, you know, suffer what's probably coming. The retiree dividend stocks will be different than dividend growth. These will be low, excuse me, lower beta. So this isn't really done yet. Our alternative income, a lot of REITs. International stocks, working on this list. Dividend watch list. Growth watch list. Some small and micro cap companies. What's left of the fossil fuel stocks that we have. So, you know, all this is coming along. People ask me why it's not done yet, and I'm like, I read 50 hours a week. It takes time to research companies. So, and we got 2 other guys doing it, and we're, I'm getting information on all these things that I subscribe to. So it takes time. It takes time. Will that coincide with your recession prediction? RJB, can you clarify that? I kind of lost my place. Does AR ever come back? Yeah, I think Antero's in a great spot long term. Clearly, the short term has been painful. And once again, and I have said this any number of times, I'll repeat it. Antero got beat up for 2 reasons. One, they had some people cash out that were part of the IPO, right? Their lockup periods, or long-term lockup periods expired. They retired and sold. And the constraints on exporting and transporting natural gas out east were significant, more significant than we thought. And because the market is traded thinly and there was downward pressure and there was a bad narrative short term, the traders traded it down. That's all there is to it. It's that powerful. 30, 40, 50% moves are not unusual. What you have to decide is, what do you do about it? Do you sell down there at the bottom? If you think the company's going out of business, yes, you do. If you don't think the company is going out of business, then you hold and maybe you add, depending on your asset allocation and risk tolerance. I don't care what 43 analysts think, Dave. Analysts are wrong 80% of the time. How do you like that for a statistic? 80% of analysts are wrong. They just are. And here, I will show you something. We go to Zacks. I don't know what their rating is for them, but what Zacks does is it rates whether or not this could be a 1. We'll see. Rates the change in analyst expectations. Right. So they're falling. They were a 1 a while ago. There's not very much value. There's not very much growth, which is what I said. They're surviving on the momentum of the Facebook name. This equation, when the value plus the growth and the momentum are dependent on momentum, that's bad, because eventually growth and value went out. Eventually. Short term, it's a voting machine. Long term, it's a weighing machine. If the price is too high and the growth is too low, the momentum will disappear. And I'm telling you that Facebook has very little growth left. The analysts agree and the numbers agree. And the stock price is kind of high for what they're going to grow, right? So their PEG ratio is getting worse, not better. If you are banking on Facebook going to 300 or 400, and you're willing to take that type of risk, you might as well invest in a small cap. Maybe get lucky and get a 10-bagger. Because it is just as possible that Facebook goes back down to 100. Right? Fell off a cliff right there. Hit support, bounced off. Hit support and bounced off. What happens, because this is a bad trend, when stocks fall like that, right? When you get that pattern right there, you should be scared. Because what's the next thing that could happen? Break support. And then where's the floor? Go to the 5-year chart. The floor is way down here at about 75. Look, right there. That's your floor. I'm not saying it will happen. I'm just saying that that's a real risk. That would be a 65% drop in Facebook. And again, I only said it would go down to right around where it went. It did. I wrote that article, and it did exactly. I think I wrote the article here, saying Facebook would go down to around 100. It got down to 125. It rallied. But look, this is not a good trend. It's not. It would not surprise me to see the stock go to under 125 and potentially go all the way down to 75. They don't have the growth, and it's not priced for its future anymore. It was priced for its future back here. When it fell off after the IPO, this is where you wanted to buy Facebook. And I sold most of mine here on this plateau in the 75s, around in the 70s. So I sold most of mine. Sold the rest of it up here. But, you know, and I sold out right before I wrote that article telling people to sell. I sold the rest of mine. I had a couple shares, not much. Then it went down, rally, now it fell off. This, I'm telling you, this should really bother you. That should bother the hell out of you. That's the market telling you that somebody knows something. That's what the market is telling you. You know, think about this. The stock market in the short term, voting machine. It's sentiment. It's people glomming on the short-term narratives and then running back and forth. If the market is heavy with retail investors and stock buyers and foreign investors, then the traders don't move it that much. But when we're short on foreign investors and retail moves largely to ETFs, volatility will be much, much bigger. That means avoid the middle of the market. With Facebook, if you think the upside is 300, but I'm telling you that the downside is 75, you're basically getting a 1-to-1 ratio on upside to downside. That sucks. That's flipping a coin. Now, Facebook drops to 75 and then starts paying a dividend, I'll buy it then. Or if they have some good M&A and start paying a dividend and they're under 100, I'll probably buy it then. I'm not buying it at 172. Treasury yields going lower. Like I said, I think during the next recession, whether that's next year or the year after, whenever the next recession is, Treasury yields go down. I was just talking about this over at FA Trader. I pointed out, one, the stock market does not move short-term on fundamentals. It moves on sentiment driven by emotional response to narratives, the power of storytelling. The market only becomes a weighing machine in the long term. And here, I talked about the real risk in the market is that inflation is the boogeyman, whatever you call it. I call it the boogeyman, not inflation. We're not short on resources right now, although food could be a problem someday, and water could be a problem someday. But oil probably will never be a problem because we're going to use less of it. And the metals, the lithium that we need is, they're going to start using half as much lithium to get just as good a battery. And zinc is looking like a viable alternative in a lot of battery applications, especially where space constraints are less important. So, we probably don't have a shortage of metals either for a battery-powered world. Solar panels, right? Silicon gets more efficient all the time. The other types of solar panels are getting more efficient. Windmills run into physical constraints just because there's friction. But, they just, on the solar, they just figured out a problem. They couldn't figure out why brand new solar panels, like automatically, kind of like walking off the car lot, automatically lost some efficiency. They just figured that out. So solar panels are going to become 2 to 3% more efficient, percentage points more efficient. That's a 10 to 15% jump, probably in the next manufacturing cycle. GDPR. I don't even remember who GDPR is. So I probably don't have an opinion. GDRP? Who are you talking about? Are you talking about General Dynamics? Who's GDPR? How do you think GDPR and other regs are going to hurt them? You're going to have to run that one by me again. It's not a ticker. General Data Protection Regulator. Oh, Jesus Christ, man. Talk to Beth about that. Is that the thing where they're not going to be able to sell data anymore? Not the way they've been doing it? Is that the name for what I've been talking about? Yeah, okay. Yeah, it's coming to the United States. It's going to happen. Selling your data is not going to be the big business that it was. It's just not. Yeah, we'll see how all the trade things go. All right, I'll let you go. It's been an hour. This was kind of a long question and answer session. I think I got to all of them. We'll have to keep an eye on trade. I'm not so sure. Like I said, in the last several months, I've been telling you that my faith in positive developments keep going down the longer it takes. And I think that President Trump is motivated to satisfy his base because of what his next career is going to be versus cutting a deal with China, what I called a fake deal. I don't think he's going to go for the fake deal. I think he's just going to let there be a no deal, and he'll talk about it for a decade online and on TV, right? And he'll get his kids involved. Although, with the exception of Ivanka, does anybody like the boys? I don't know. I think they're both kind of mutton heads. So I don't know. They don't have their dad's charisma, that's for sure. And Jared Kushner, you see that interview the other day? Oh man, he just screamed out Weasley. I'm Weasley. I'm Weasley. So, we'll see. But I think there's some trading that we can do a little bit. But if you're not feeling up to trading, it's okay to, have a very conservative asset allocation. If you don't want to sit in cash, Ginnie Mae's maybe. Ginnie Mae Fund, GNMA. That way you don't have to worry too much about interest rates. You just collect the coupon and it kind of drifts along, right? So Ginnie Mae Fund, GNMA, right? Just kind of drifts along. That's a very narrow range, right? 50 to 47. Kicks out a coupon for you. Whatever the coupon is, 3%. Right, if you want better than a money market rate. Although, a lot of the money market rate, interactive brokers I use, they pay like 2.5%. So, we'll see. I think a lot of our opportunities coming out of the corrections of the next year or two are going to be international and then new economy driven, right? Smart everything world, alternative energy, things like that. I'll say it again. Find ways to get out of your grandpa stocks. So, in any case, yeah. Facebook is going to keep making money on targeting ads. Big deal. Less people are using Facebook, right? Less people, less often. Facebook has peaked. Their business has peaked. I will stand by that. And when people realize that their business has peaked, they'll reprice. They'll right price the stock. And I think the right price on that stock is between 75 and 125. It's a pretty big drop. So, all right. Yeah, India. We need to get more into India at some point. All right. Have a great weekend. I will be in Las Vegas the next 3 weeks playing in the World Series of Poker. I will be doing the show every Friday morning. I'm efforting to get guests. And I did a little warm-up last night. Let me end the. We'll talk about it. We'll leave this at the tail end. I'll put up some sort of cap at the end of the video. But I was playing in a tournament. I was doing very well, and I had a couple of bad beats, and I got into a hand that did not have to bust me, but it did, because I made a decision on the flop, and I had a good read on the guy. I knew that he played big face cards, and I knew that he overbet and tried to take things down with fold equity. I knew everything about this guy, and I played an ace-8 behind him because I figured that was in the lead. Ace of clubs, 8 of hearts. And the board came out with 3 hearts. No face cards, all below 10. And he overbet the pot. He bet double the pot. So he bet as if he had hit a set. I knew that he didn't. I called. On the turn, I checked to him thinking he'd bet again. I screwed up. He checked back to me. And then the river came out the 4th heart. So I'm sitting here thinking, I got the 8 of hearts. I missed a bet. I think this guy has a heart that's a face card. He goes all in. I check. He goes all in. And I'm thinking, that could be a problem. Yeah, I don't have any tells. I tell people what I want them to know. I lie all the time about what I have after my hands. 50-50, I'm telling you the truth. Almost exactly 50-50. Maybe 1/3. That's almost 50-50. Anyway, I decided that I would rather know if I'm right about how bad I did and what ended up happening than winning that tournament. And I was only half the average stack. I could have jammed another hand and gotten back to average, but the cash tables were waiting for me. It was only $125 buy-in. So I say, well, if I'm right, I'm out. And if I'm wrong, I win. And so I called, and I said, I only have a shitty heart. And he goes, I only have a shitty heart too. And I'm like, oh, maybe I win. He flipped over to Queen of Hearts. I mean, he didn't have the king, which was the high card. Oh, I had hit the ace on the flop. I take that back. There was an ace on the flop. Ace of Hearts is on the flop. I had an ace. So I didn't bet my aces on the turn, and I should have. So I ended up being right about everything. The mistake I made, how he sucked out, and I lost. Went to the cash table, made all my money back, and then some. Kind of tore up the cash game. Had everything going for me in the cash game. The way I was talking, the way I was playing. Understood everybody at the table, and I think I maybe missed one or two bets, but I don't think I really lost anything. So hero calls are bad only if you're wrong, right? Hero calls are bad if you're wrong. Don't make a lot of them, but we'll see. I am playing in 5 tournaments that are big tournaments. I'll play in a couple little ones too, but I am playing in the Monster Stack. It'll be my second time doing that. I'm playing in a couple of other no limit hold'em tournaments, and I am going to play PLO over at Binion's on Monday the 17th. And I will tell you, my Omaha game is better than my hold'em game, and my hold'em game is enough to make me a crappy pro. So we'll see. I'm a crappy pro because I beat the cash games. I have never run super deep in a tournament, a big pro tournament. Yeah, a lot of min cashes. And I think like a third of the tournaments I've played, I've min cashed or close to min cashing, maybe 1 or 2 steps in. Have not had a super deep run, so I have to not miss bets, take a couple of more empty pots, limp pots, and run hot. So we'll see if I can run hot. But it should be fun. I'm going to try to get a couple of poker pros on the program, and we'll see what happens. In any case, have a great weekend. Enjoy the weather. Wisconsin is finally nice. It was a long, rough fall, winter, and spring here. So, all right, take care.